Hello, everyone, and welcome to Forte Financial Mortgage Group podcast. This week, we have Christopher Miller, one of our usuals, obviously, our team leader and loan officer here at Forte Financial. But this week is going to be a really good podcast because it's very overdue. We're talking about reverse mortgages and some very special, new, and unique variations of reverse mortgage products that most people are very unaware that are available to them. And we want to let our viewers know what's available. Chris, welcome to the show.
Thanks for having me again, James. Always good to be here.
Absolutely. No, this has been a fun ride since last year, I have to say. The viewers have grown tremendously, and it's been rewarding.
A lot of good information getting out there.
We're helping people. It's with a lot of our, especially our new 0% down program, the followers, and it's been very rewarding. I feel like one segment we've, I don't want to say neglected, but it's long overdue, as I stated earlier, is these reverse mortgages. You and I have both been doing a lot of them recently, and there's not enough education out there. I don't see anything out there. You see these infomercials with,
there is a notorious black cloud hanging over the whole verbiage of a reverse mortgage, no matter how you look at it.
Yeah. So let's start out with what actually is a reverse mortgage. Now, do you want me to take it, or do you want to start?
No, go ahead.
So reverse mortgage is exactly what it sounds like. It's a mortgage in reverse. What it means is that you have a mortgage that has no payment. You have no payments due when you take out a reverse mortgage. And when I say reverse, so each month, whatever the interest rate is on this reverse mortgage we give you, your loan balance of let's say it started out at $300,000, just using a number here, that balance grows slightly every single month because you're not making a payment. So there is interest due, and what happens is the interest due for that month that you would have normally made a mortgage payment, the interest portion is added on to the principal balance, and there's never a payment due. So the whole premise behind why this works, and a lot of people just don't understand, is your appreciation rate. So it's if you look at charts and the algorithms, if when it grows out in 20 years from now, although your interest will have accrued, your value also will have accrued. So you should still be in a positive place value-wise, meaning still more equity than when you started, even though you haven't been making payments. That's the basic premise on this. So Chris, I want to start out with one of the biggest, the newest programs. It's called our Home Safe Second Mortgage. So a lot of people who own homes right now, they have a first mortgage. Let's say in 2020, they called Chris Miller and got
a nice low rate under 3%.
A 2.5%, 3%, 3.5%, 30-year fixed rate. They don't want to touch it. So most people, which are customers, we're doing HELOCs right now. We're doing traditional home equity line of credits for them, right? But a lot of people, they, if they're older, so let's just back up for a minute. This is really cool because a traditional reverse mortgage, you must be 62 years of age or older to qualify for a traditional reverse mortgage, which we're going to get into today. But the new product that we offer is a second mortgage. It's like a home equity product, but it's a Home Safe Second. You only have to be 55 years old to qualify for a Home Safe Second. So specifically, Florida residents, if you own a home in the state of Florida and you're 55 years of age or older, you may qualify for a reverse mortgage second, or I should say a reverse second mortgage, where you can take out anywhere from $50,000 up to $1 million, qualify with no income verification, so stated income on your application, nothing verified, with no payments due. You do have to have a good amount of equity in your home. You do need to have had your first mortgage for at least 2 years and have paid that on time. You will need a decent credit score of 720, but if those three boxes are checked off and you have a good amount of equity in your home in Florida, you may very well qualify for anywhere from $50,000 to $1 million second mortgage, no interest due. Yes, there's interest that accrues, but meaning you don't have any payments. You won't have any payments due. So if you want to learn more about this, you can visit our website at www.fortefinancial.com, and you can apply now, or you can go there for more information. Again, if you're in the state of Florida, please reach out. You can also call and speak to one of our qualified loan officers at 475-215-5401. Chris, let's talk more about the traditional reverse mortgage. I know we kind of went out of order. It's just my excitement for this new program. Everyone's talking about HELOCs today and equity lines of credit, and this home safe second mortgage. It's a fixed mortgage. It's not it's not an adjustable line like a line of credit. You take your whatever it is you want at closing, your lump sum. You pay off credit card debt. You can pay, do home renovations. Whatever you want to do, you can pull this money out now, do it, have no payments. Like, think about it. If you're older, you're 60s, 70s, 80s, and you have a first mortgage, like, you'd like to pull some of that equity out now. Maybe you want to pull it out and give it to your kids now. Why wait until, the passing? Give it to them now. You can use it now. That's it. There's no payment due. So reach out to us on that. But Chris, I want you to explain a little bit more about the traditional reverse mortgages that we offer here. And, we'll get into how they're really not as bad as a lot of people think, because there's a bad rap with reverse mortgages, isn't there?
There is. I mean, and everybody that comes across either the phone calls or the desk that you meet and talk about, they immediately have a negative, we'll call outlook.
Like what? Give me some examples of.
Oh, well,
negative.
they're just going to take my house. When somebody passes, they're just going to take the house.
Hold on, pause there. That's a great one. Let's talk about that. So what happens when the homeowner passes away and you have a reverse mortgage? I know so many people want to hear about this.
Well, I'm actually working with somebody right now, and the conversation is just, okay, well, what's the debt going to look like in 7 to 8 years, which is, unfortunately, when we're doing these, we're talking about life expectancy because a lot of these folks that are doing them are older. But as a family member or someone that has interest in the property, you do have the right to essentially pay off the debt and keep the house. They do give you the right to do that. So that's something.
Let's talk about timelines. So for the viewers out there, it is not when the borrower passes away, the bank takes your house. It is not how this works, okay? There's an incredible amount of time given to the family. First of all, there's a point of contact whenever we do a reverse mortgage. There's it's usually a son, daughter, children. It's usually someone like that, whoever it is that's close to the borrower, the applicant, that will help manage everything. They are who our reverse mortgage lender is going to come and reach out to when the time comes that the parent or whoever it is passes away, and there's going to be an initial letter that's mailed out that outlines. Initially, it looks like, there's not a lot of time because the letter states, oh, you have 30 days to decide what you want to do. It's just the initial letter because they just they're all that we're looking for. And if you read through all the fine print, they're just looking for a response. There's communication. So the reality is they have at least a year to figure out what they're going to do with the house, sell it, refinance, pay the debt off. There's at least a year. It's just there's communication. You have to respond. They want you to respond within the first 30 days. Say, okay, hey, our intention is, we're gonna, we have siblings and we're gonna sell it. No problem. You list the house for sale. Every 30 days they just want communication. That's all it is. They want communication every 30 days. Because if you don't respond and no one's taking action, then there is a right to foreclose or begin proceedings, which first of all would take at least 6 months to a year anyway. But that's not going to happen if there's communication. So,
and that's a good point. And that's something that I think most people don't realize, that they do have the right to still sell the home on their own.
Of course,
it's not like the bank takes the house and sells the house for you and kind of goes through that whole process. It's only if you allow them to do that and don't communicate. But I'm working with someone right now. I'm trying to communicate that you still have the right to sell the house, but this lien that you've essentially established as a reverse mortgage, whether it be a line of credit or a second, that has to get paid before the proceeds can be distributed to family or whoever else has an interest in the home.
Absolutely. So just a little bit of a recap. When the homeowner passes away, it is the right of the family to decide what to do. They don't have to sell the house. they can keep it. Sometimes, there's a few siblings and one sibling wants to keep the house and, buy out the other's interests. So whatever is, that they have to pay off. There's obviously a balance due on the reverse mortgage. And if no payments, were made, obviously in the event. So, I shouldn't say it's obvious. Let me back up there for a minute. We're going a little bit all over the place, but I think it's relevant to this piece of the conversation. There's really a few different ways that the traditional reverse mortgage is done. It's in the form of a line of credit. Mm-hmm. That is the most popular way, which we'll go into in more detail. A lump sum or tenure, where the line of credit gives is my recommendation for probably 90% of the people that come through the door, because it really checks off a lot of boxes. The line of credit gives you a lot of flexibility. First of all, it's a line of credit. So you're only accruing interest on the amount of money you take. So a lot of people say, oh, well, we only need a little bit right now, right? Because they're like, the children are, want to take care. So, okay, so, people listening to this thinking about, your parents, a reverse mortgage line of credit is something you may want to think about getting in place, because it's there in the event of, you need it in the future. So let's talk about that. If somebody becomes incapacitated, mentally incapable, via a doctor's recommendation of making financially sound decisions, and nothing was done in place previous to that, the chances of getting a reverse mortgage at that point in time are slim to none. You must have established, if somebody becomes mentally incompetent or incapable, dementia, Alzheimer's, things like that, there needs to be something in place, a power of attorney executed prior to this time, that we can document that the potential borrower was competent at the time that they filed and executed this power of attorney and gave it to their kids. If that was done, then we're in good shape. Predatory lending with the elder class, there's just so much protection there for seniors that it's almost too much protection. Obviously it's not, but in cases of people are worried about kids taking money out of the parents' house for and just causing financial harm. So this is one of the safeguards. So the point is, if you want to protect your parents, if they own their home free and clear, or there's a small mortgage balance, you could put in this reverse mortgage line of credit now. You're taking a minimum draw at the closing, and it just sits. It's almost like a credit card. It just sits. How it does, there's no expiration date on this. So it's not like a 10, 20, 30-year term. It's for their life. It's as long as they live. And what's cool about it is if they don't take any money, say they get this $300,000 line of credit at closing, right? They don't take anything. They just take what they need for closing costs at the closing and minimal, right? Set it out. That balance, the available equity, that grows every single month. So that 300 in 10, 20, 30 years from now, could be $600,000, $700,000, $800,000, and that's another tool to protect the value of your home long term. Like, what if values just crash all of a sudden? That continues to grow no matter what values do. No matter what values do.
There's mortgage insurance on those.
Yeah. So the point is, you could have available 2-3 times as much if you don't touch it 10, 20 years down the road. So if you get a line of credit for your parents that are 62 years old and you just let it sit, so they're not accruing interest. If it sits, you're not accruing any debt. The balance is not growing. It's there. So then let's say 15 years from now, they need help. They're in a nursing home. Like, it's there. You don't even have to think about this anymore. And it only grows and gets better. So something to think about the line of credit. But aside from that piece of using the line of credit, some people say, okay, well, our parents are going to need help. They're in a home. It's very expensive per month. They can take this out and just draw on it every month or every couple of months whenever they think they need the money. And this way, they're not accruing the interest prematurely. They're not accruing that balance prematurely. They're only accruing what they need, and the remaining availability continues to grow every month, which is really cool. No payments due. So those are some tools for that. And Chris, why don't you tell us about the lump sum version and perhaps the 10-year version and what would be a good situation there?
Well, I mean, the just to give an example of the line of credit, actually, because I'm working with somebody right
Sure.
now, and their initial loan balance is going to be about $20,000 for their mandatory obligations, which is paying off all their closing costs and everything that go with that. Obviously, it's a larger line. That's why the obligations are a little higher. But the growth factor, and the gentleman happens to be in his 80s. So, obviously the questions are, what's the actual growth factor? What's that look like? But over a 10-year period, it's starting out, in the $300,000 range. But by the time, I would say in that 10-year period, it grows to almost $700,000 as far as being available. So, explaining to the family members, the key point is, maybe right now he doesn't need it. So you're just going to take out the mandatory obligations to cover the closing costs. So you're not necessarily, you're not using any of it for anything that you don't actually need. You're accruing minimal interest. But, maybe since he's in his mid-80s now, maybe when he's 91, he needs long-term care or something of the sort. They can basically have these payments withdrawn every month, or having the disbursements taken every month to just pay those long-term care bills, or a lump sum and then just pay it themselves. But it takes, like you said, it really takes the burden off of the family, and I think that is what I'm seeing is the biggest factor behind all the financial part of it, is just the amount of pressure relief that the family sees from having this kind of, we'll call it like in their back pocket when they need it.
Yeah. No, that's
it's just a nice feeling to be able to say, like, okay, this is a great plan in place. He didn't have any life insurance. He really didn't have a lot of savings. He's on Social Security, Medicare, Medicaid already, and they're already in a deficit from covering taxes and insurance. So we're also going to do a holdback for taxes and insurance, so that at some point, there's no concern about making sure that the kids have to make those payments.
It's almost so. Listen, I'm at that age too, where parents, family are getting older, and how many kids listen, I want to say kids because I'm clearly not a kid, but how many adults our age have older parents that what's the plan for them? What is the financial plan for them as they get much older? And the key is, you don't know when that switch goes off where they go from being self-sufficient to needing a little help or a lot of help. It can be like a switch at times, and we just don't know. Yeah. So this reverse mortgage line of credit gives you a tool. Something else to talk about is, like, specifically, let's talk about, because we're in Connecticut, right? If you live in Connecticut and you have family, your parents are getting older, and you're concerned about what to do, how to help prepare financially for their future, you may want to consider giving us a call, having a consultation, letting you know what a reverse mortgage line of credit will look like that we can put in place, that is not touched, that is available with no expiration, so that if and when they do become incapacitated or they do need it, it's already there. And it grows if you don't touch it, as we said earlier. But you may want to give us a call to talk about it. You can get more information on our website, www.fortefinancial.com. There's an education section on there with this podcast will be on there. You can listen more, or you can of course apply now there and give us a call. This is probably one of those that you probably want to have a conversation first. We can do phone, in person, Zoom meetings. Not a problem. So we're here to help our Connecticut fellow residents in planning for the future. So it's a tough thing to talk about. Nobody wants to deal with it, but we all have to. You know what I mean?
A good question that I got this week was, what if I want to pay the mandatory obligations out of pocket so that there's a zero balance and there's no interest accruing?
I love it.
And so just to have that peace of mind, they said, you know what? At that point, it gives us, there's no growth of a balance. The balance went from, let's call it $20,000 to maybe $45,000 in let's call it 10-year period, if they took no other money. But they said, you know what, why take the risk? We'll just pay the closing costs, and this way we're not accruing any debt, and we have full availability of the entire balance whenever we need it.
I mean, I've done many reverse mortgages, lines of credit for families just like that, where they just pay the closing costs, they don't want any balance, and that is the most powerful tool you can give your parents. Most powerful tool. because you don't know what's going to happen. You don't know how much money they will need. You just don't know. Yeah. And having access to that, before it's needed is the key. Because again, I'm going to harp on this. If you're not prepared and, legal documents aren't put in place and your parents become incapacitated, they're not going to qualify for a reverse mortgage. If they're not mentally capable of handling this, and there's no POA executed prior to them being incapable, they will not get approved. It's not going to happen. So just trying to help people be aware, because a lot of people, I'm sure, have no idea. They think, oh, well, when they need it, I'll get it. Oh, how do you know they're going to qualify at that point? Things need to be put in place. At the very least, if you think you're going to wait till they need it, get a power of attorney in place now while they're mentally capable of making decisions, that they give you power of attorney and have that documented. Then if you want to wait, fine, wait, but it's just, you have to be prepared. I'm just trying to, our whole point here is we're trying to educate, and I feel like the reverse mortgage is something we haven't educated enough of.
Well, talking about the second for a minute, just kind of switching gears.
No, the second is exciting. It's great.
The last conversation I had with somebody about that, I want to say they were 58, and they were talking about retiring at 60. And the conversation was, well, I have this much equity. I owe this much on my first mortgage. I want to retire, but I have X amount of debt payments per month from, 2 cars, credit cards. I'm still paying off student loans for one of my kids, and I think it added up to maybe $150,000. But the payments per month were like $3,000 a month. Mm-hmm. And so the concern was, well, if I retire, my Social Security is only going to cover this. My 401k, which I really don't want to start until later on, is going to cost this. So how does this Home Safe Second come into play? Well, guess what? It steps in, obviously, if you have the equity, and it pays all those debts, and you don't have to make a payment. So yes, it's technically a second lien on the property, but it gets rid of all those debt payments so that this person was able to say, okay, well, then I can make the decision to retire knowing that those debt payments go away when I do this.
I love that. So we have to be real careful here because it's very state specific. The Home Safe Second, this is our beautiful new reverse mortgage, second mortgage. It's available in the states of Connecticut, Florida, and South Carolina. Currently is where we are offering this program. So if you're in those 3 states, you can get a second mortgage if you're 55 years and older, and you have a first mortgage, you have a 720 credit. There's a couple variations of this, but the best version is where there's only stated income. You don't have to verify any income for this. You have to have a 720 credit score or higher. You have to have your first mortgage in place for 2 years with perfect payments on time. Yeah. And if that's in place, you may qualify for a stated income where you just state income. We don't verify anything. And granted, the key is you have to have a good amount of equity in the home. But what's really interesting, a lot of people don't realize, is there's actually more available on a second than it would be on one big first, because you've already locked up some of the available equity in that fixed rate first mortgage, which we know can't grow. It only goes down. So that second is actually a higher loan to value. So it's another thing, if some people are a little short on qualifying for the traditional reverse mortgage because they don't have quite enough equity, the Home Safe Second may be the solution where they could get a little extra out. And we go anywhere from $50,000. We can do as little as $50,000. Okay. HELOCs are really hard to get at $50,000. Like hard. We have a lot of traditional borrowers who want HELOCs, and they come to us and they want $50,000 or less. It's like, it's really hard to do because there's closing costs that we normally, with a lot of our HELOCs, we give credits for most of the closing costs. So we try to make them as cheap as humanly possible. That's very difficult to do at $50,000. So the point is from $50,000 up to $1 million. Let's just say, for example, you live in Florida. You have a $4 million house in Florida. You have a first mortgage of, I don't know, $700,000. You can take out $1 million second mortgage with no payments due. No payments due. And pay off debts, pay off whatever. Student loans, do home improvements, whatever you want to do with that money, you could take up to $1 million with no payments on a second mortgage where you're not touching that beautiful 2.5% first. It's a beautiful thing. It really is. So, I mean, I think that's a powerful tool. We're just trying to get this out to our audience. What are some other concerns, some other gripes? Let's talk about some of those gripes.
I mean, one of the things I always get is the mortgage insurance, that there is a monthly mortgage insurance fee, and that's kind of we'll call it not a complaint, but just that's one of the common questions. Why is that there? Does it ever go away? No, it doesn't. It doesn't. It's the reason it's insured is in case for some reason the value is ever lopsided, and that insurance would cover that. So that's kind of the purpose of that point. But I would say that generally speaking, the closing costs are not really anything different than a regular closing on a mortgage, from what I'm seeing so far. But
yeah.
The biggest question I got is the mortgage insurance.
Closing costs are not cheap, but they're also not crazy. So many years ago, when reverse mortgages really started hearing more, a lot about them, it was a lot of people that got taken advantage of. A lot of seniors got taken advantage of. And unfortunately, that's given a bad rap for the product in general, which it's so much, the whole industry is regulated. I mean, since the SAFE Act came out and loan officers have to be originated and compensation plans put in place, it's you can't do that anymore like people did back in the day. So again, they're not cheap, but they're also not astronomical.
I mean, they force the borrowers to go through a whole education process, and you have to have an advocate that goes through with you, and you sign off.
Pause for a minute. That's excellent. Let's go over what are the steps if you're a senior and you want to get a reverse mortgage. What do you have to do? So step one,
fill out the mortgage application.
Fill out a mortgage application that can be done on the phone, face-to-face, online. We have an easy online application.
I mean, it can be done from your phone. If you're tech savvy and you want to use a smartphone, it's very easy to do.
Yeah.
So that's the biggest step. I would say next step, obviously, is for us to do a soft pull on your credit and get a base credit score and take a look at that.
And within 24 hours, we're going to tell you, this is what we will potentially be able to do for you. Here's what the numbers will look like. Here's what the estimated rates available, cash out. We have a lot of online tools where we can do a good estimate on our end of what we think the value of your home is. Clearly, all of this will be subject to an appraisal down the line, but we'll give you a really good. It's actually our proposal package. We're going to give you a proposal package, which is going to have 3 options. That's just part of the package. We can give you, as many that make sense as possible, but you'll have 3 options, which will give you all the best possible ways to do it. You can see what it looks like. There's no obligation. But once we do that, what's next, Chris?
I'm trying to go back in my head where I'm with this.
Okay, so once we go over the proposal with you and you accept that and you're happy and you want to move forward, we'll send you out a full package, a full application where you just have to complete our disclosures, our application. Once we have your application and disclosures, the next step, which is the most important part, is the counseling. So you will need to do a reverse mortgage counseling, okay? So the senior, the borrower will need to do it unless they are, incapacitated or mentally incapable of doing it, as long as the son or daughter or whoever else has been given power of attorney, and that's been documented via doctor's note that was done prior to them being financially or mentally incapable. Then that person, the son, daughter, whoever that is, can do the reverse mortgage counseling for the senior in that case. So the reverse mortgage counseling can be done in person or on the phone. It's about 1 hour long. It's pretty simple. Appointments these days with our qualified institutions are very easy. I have a client right now that just did it last week. He said, they basically were like, when do you want to do it? So he made a phone appointment, and I had the certificate back the next day. It was really fast and easy. So it's 1 hour long. One thing just to prepare you, this counseling can. I don't love it. I'm happy they do it because there is definitely general information that they do go over, which can be very helpful. But also there's some information that, like for example, with mine, we just did the counseling, and my client was very concerned. He goes, James, I know we talked about it. You said that I had 6 months to a year after my father passes away to, refinance, sell, whatever we're going to do. And they're telling me it's only 30 days. And I'm like, okay, first of all, they don't know exactly what program we're doing. They just know you're doing a reverse mortgage. And then I of course, I went into and explained to them how, hey, the initial letter you get wants to know what your plan is within 30 days. It doesn't mean they're going to initiate foreclosure proceedings if it's not paid off. It just means they want to know what your intent is. You communicate back to them, let them know, hey, my intent is to sell the property. Okay, great. Every 30 days, they want to touch base. You do have to communicate, but if you're communicating and there's progress, they'll let this go a year, no problem. So it's not the lender takes your house. We got off topic. Counseling's done. What happens after the counseling is done? We get the FHA case number ordered. That's something we do internally. We're eligible to pull that once we have a signed application, disclosures, and counseling certificate. And once we have that, beautiful, we order your appraisal. That's really when once the appraisal is done and that comes back, then we're able to really confirm all the figures, and the other documents we need from you will go into underwriting. And that's a very quick process. I mean, underwriting is 24, 48 hours, and then they'll let us know once that's done, anything additional we will need before we can get the clear to close. But it's fast at that point.
That's a good point, and something I think we should talk about is appraisals. One of the ones that I did recently, there was some issues with the house that needed to be repaired as part of that. So
what now?
Well, that's one of the things that's going to come up. So if
of course it is.
Because technically is based off of an FHA appraisal, so they're more strict with the condition of the home, peeling paint, broken windows, health and safety hazard type things. Definitely something to be aware of. Now that doesn't mean there are not ways around that. So for example,
a lot of ways around that.
In this particular case, the borrower's family decided that they wanted to do the repairs before the closing. Okay, fine, no problem. But in the instance that the family doesn't have the money to do the repairs, if there are repairs to be done, there are ways to handle that. There are the lenders will allow an escrow holdback so that the repairs can be done after closing. So the family is not burdened with the repairs just to get the loan closed. And then the attorney will help distribute those funds as the contractors complete the work to the home. So for anybody out there that's looking to do this, that says, well, my house is in bad shape. I need this. I need a roof. That's why I want to do it, right? That's why I want to take the home safe second, because I have all these things, these deferred maintenance items that need to be taken care of that I just don't have the cash flow to do anymore. Well, this is a perfect example of how to get some of those things taken care of. They'll do an escrow holdback, and your attorney can help you manage those funds and get the repairs done. And again, you're still making no payments. Somebody is just helping you manage those funds as they get dispersed from the closing.
That's great. That's a great point, because if you think about a lot of seniors who own homes that want to do this, they've gotten older and they've let the house go in a lot of cases. Yeah. So yeah, I've had a few of mine recently that I've done, all had like little things that needed to be done. And in all those cases, the borrower either did them or, we, like you said, we did an escrow.
Mine was that they needed to paint the entire house because there was issues with siding and things like that. They needed to strip and repaint and repair a deck. There was a solid $8,000 worth of work to be done at the house, and it was no problem if they wanted to do the holdback. Yeah. So they chose to do it, but knowing they're going to get reimbursed, but that was their choice. But the option is there. If you have a home that is in need of some work, there is definitely a way to still do the reverse mortgage, whether it be the credit line or it be the second, and get past the appraisal portion of it, knowing that you might have some issues.
So how do we get started? If borrowers listening, potential, children of elderly that want to get financially prepared for the future,
I would say just call us. I think, I've spent hours on the phone with families recently just talking about how to set it up, what the best structure is for the family. What, do you want to take a disbursement at closing and a monthly payment? Do you want to take just a lump sum? Do you want to take just a monthly payment? Do you want to do nothing and just let it sit there and grow? Yeah. Whatever is best for that family and their structure or their needs is what we're going to help them do. And I think the biggest thing is just having those consultation phone calls and kind of getting past some of those initial, we'll call it not necessarily outlooks, but get past the initial negative thoughts about a reverse mortgage.
Yeah, yeah. No, it's huge. There's not enough education out there. So especially in Connecticut, there's not that many lenders. There's a lot of lenders offer this program that, in Connecticut, but they don't really fully understand it and they don't go after it. It's not, for a loan officer, it's not the simplest program. You have to You have to really understand these products like we've taken the time to do, and
you have to be willing
go
to
out and
spend the
educate.
time.
There's not that many loan officers in Connecticut that are really going after this. And I personally, like, again, if you're a Connecticut resident, like we want to help educate you. If you have a family member that is getting older and you're concerned about what's the plan when, they really need help, let us at least present that to you. We're not high pressure salespeople here. Here's what it looks like. Let us know any questions. Great.
Yeah, does it work for you and your family? Great.
You want to have a quick 5-minute conversation on the phone to start? Fine. We get past that. Okay, well, let me go back and talk. And, some of these things, there's a lot of back and forth for a long time before we start. But the idea here is for some, like I have a borrower right now that I'm doing. He's like, we need to get this done now. I'm like, okay, this is what I need. And as soon as I have this list of stuff, we can close in 2 weeks, no problem. 2 weeks. Once we have all the things that we need in, which is not a lot of stuff. So give us a call, 475-215-5401. Get educated. Let us show you what a reverse mortgage line of credit looks like. There's again, a lot of misinformation out there that we want to help clarify. What else, Chris? So I think we've talked about some of the negative kind of just cloud over these, and it's just frustrating sometimes. You know what I mean? Because it's really an amazing product or products, and now with the Home Safe Second that we can do, someone might have a $200,000 first mortgage at 2.5% that they're fine with paying on, but they need all this money out to do other things. Now makes perfect sense because you don't have to touch that 2.5%. You can just take the second out and do everything you need and have the reverse mortgage be on that, which is so great. So pumped.
Just, I would say, a point that we should talk about. What would you say would be the most beneficial reason for doing a reverse line of credit versus a HELOC for somebody that's of age 55?
All right, great question. So I think that it's if somebody doesn't really need the money, I would say, and they qualify on paper, I would say a traditional HELOC would make more sense for that person that doesn't really need it. They want it, to do stuff, just have it sitting there, in line. That person would benefit more from a traditional HELOC. Somebody who has a direct need and wants to use it for something, doesn't want to have to deal with the payment. They're older, they're stressed out, they don't want a monthly payment, but they need the money to do stuff. That's a home run for the reverse mortgage safe. A Home Safe Second that's the way to go.
Okay.
I think that's I try to simplify it. There's obviously a million other ways, but I think those are the two big ones there. One other thing, if you're looking for a HELOC and you've been turned down because your credit score is not great and you are over the age of 55 and you have equity in the home, we can do a Home Safe Second for you with a credit score as little as 600. The only difference is from what we've been talking about earlier is that you do have to show your financial assessment qualification. We want to know that you have to be able to document that you can afford to pay your other bills. Clearly, there's no payment on the second, but we want to be able to see, I can afford to pay the first mortgage I have, my taxes, my insurance. They just want to know that you can afford to pay those things. You have to be able to document, do you have enough money to pay those items? So that's it. That's it. 600 score. So if you've been turned down for a HELOC and you're 55 years and older and you're in the states of Connecticut, Florida, or South Carolina, we may be able to help get you that money out with no payments. Pretty cool, huh? I'm almost qualified for a Home Safe Second. I'm getting there. 55 is nothing, right?
At this point.
55 is a new 40, right?
If you say so.
So, Chris, one of the things that we're so excited about that we're doing a ton of is our DSCR, means debt service coverage ratio loan, where there is no tax returns, no income qualification, nothing. We qualify you 100% based on the principal, interest, tax, insurance, and association dues if it's a condo, versus the the market rent or the actual rent, whichever, if it's rented out, the lease agreement. There's a ratio calculation, but typically speaking, your mortgage payment is not going to be more than the rent. It's usually going to be at least about the same, or the rent a little bit more, or else I don't think that's a very good investment to you.
No, definitely not.
So this program allows you to buy a house, let's say in Florida. You want to buy a house in Florida. You want to rent it out. Maybe down the line, your plan is to go move down there, but you're not ready anytime soon. So you go buy that now, today, as an investment property, no tax returns, no income documentation. The minimum down for the DSCR is 20%. You do have to put 20% down.
We are seeing some new programs out there with 15, but the ratios don't always work. So I think that's,
okay. I try not to promote that piece, but you're right. Chris is correct. 15% down on some examples on this DSCR. No tax returns, no income verification. Must be an investment property. That's the key. It has to be in a high rent area. Yeah. So let's talk about Florida. You want to buy an investment property in Florida now that perhaps eventually will be your second home. I know me personally, I'm thinking already now, hey, I want to maybe retire down to Florida or South Carolina in the future, but I don't, I want to get into that market now.
Right.
You can buy a house down there right now, investment property, no tax returns, where you can buy it now, rent it out, have it paying your mortgage payment. 10 years from now, you want to go down there and retire, sell your house in Connecticut, New York, wherever you are, you're in there. Now you've got a ton of equity in that house, and you also know the area better. So maybe you're like, oh, you know what? Maybe this area is not where I want to live eventually, and you sell that and buy, something else down there at that point. So the point is, you can buy a house down there now with no tax returns. A lot of people think, oh, I'm not going to qualify. My job situation has changed. It's
I'm heavily leveraged, but so a good point. Minimum credit score is 660. It's really not that hard to get over a 660.
Well, Chris, it sounds like 2008 all over again. Let's talk about that, because I know the TikTok comments are going to be flying about 2008 all over again. Here comes a crash. No income verification loans. Let's educate our consumers as to why it's not even close to that. So first off, in 2008, the mortgage crash was loans that we gave, not me, saying the mortgage industry gave 580 credit score, no income, no assets, nothing, no money down, okay? Primary residence, no job, 0%. Yes, that is why everything crashed. What we're talking about now is 20, 25% down, excellent credit, ton of assets, big down payment, and it's an investment property that we're documenting the rent is the same or more than the mortgage payment. How is that a risk? I think it's riskier to give a borrower who's a first-time buyer, just got out of college, has never paid a bill in their life, an FHA loan with 3.5% down, that just got a job, last month and wants to buy a house with minimal down, and we're documenting their income. I think it's a lot more risky because they've never owned a home. They don't know expenses like that. That's a risk to me. A no documentation loan for someone buying an investment property, putting 20, 25% down, which we also have documented reserves and a lease in place or market rent of more than that payment. How's that even a risk? I don't even see how that's a risk personally. So that's the difference, ladies and gentlemen.
Well, and the cool thing about DSCR is you can do up to, I think most of our lenders do up to 20 owned properties with those types of loans. So if you are a seasoned investor and you haven't been using DSCR, and maybe you're at property number 5, 6, 7, 8, 9, and you no longer can qualify with your income, even if you are a high wage earner, these are the ways to go, because you don't even have to provide your income. So that is a huge benefit for a lot of people.
So if you're living up in the Northeast, you want to buy a house in Florida, you can do that with no tax returns, 20% down. Now, depending on how your credit score is, how much you put down, and some of that criteria, and what the actual DSCR ratio is, the rates will vary. But we're giving some people rates in the 7s on these programs. In the 7s. The
last one I did was 799.
Yeah. I mean, it depends. Like, we have options where, like, I have a borrower right now. I just gave them a DSCR with no prepayment penalty and no points. It was a 0-point loan and no prepayment penalty. Like, it's basically like a free loan. I mean, it's not free, obviously, but it meaning like their closing costs were like close to nothing. You know, a lot of people think that listen, a lot of lenders are doing these loans charging a ton of money. Like, we obviously always are ahead of our competitors. As you know, we always advertise our rates on average are 0.5% or better lower on average. Listen, sometimes we're only a quarter better, but so we're doing stuff that's very special within the product too. We're not just offering the same thing everyone else is. We're offering it and doing it better. So reach out to us, fortefinancial.com. You can apply now on our website. You know, let us know what you're looking for. We'd love to help you. We're closing these DSCRs in Florida right now for borrowers, start to finish in 3 weeks. Easy. They're simple and fast. What else you got, Chris? Well, happy 4th of July. Everyone be safe out there. Have fun. And we'll see you soon. All right. That's it.